Imagine standing at the edge of a freezing cold swimming pool. Do you jump all the way in at once, or do you take the stairs and slowly wade into the shallow end? If you have $12,000 to invest today, jumping straight into the deep end is what we call lump sum investing. You take the entire amount and you buy your investments right now, all at once. Taking the stairs is dollar cost averaging. Instead of investing $12,000 today, you invest $1,000 every month. When the market is high, you buy fewer shares. When it dips, you buy more. Ultimately, your cost averages out. Wading in slowly feels safe. It makes intuitive sense, especially if you are new to investing and worried about making a mistake. But decades of actual market data tell a completely different story. What feels safe in our minds often contradicts the math. Vanguard looked at 90 years of market history. They studied the United States, the United Kingdom, and Australia to see which strategy actually wins. This chart shows the exact breakdown over a 10-year period. The lump sum approach beat dollar cost averaging in 68% of all 10-year windows, and the gap is highly measurable. The lump sum investor walked away with an average of 2.3% more return over a decade. The reason why comes down to a basic historical fact. Stock markets generally go up over long periods of time. Every month your cash sits in a savings account waiting to be invested is a month it misses out on that growth. In finance, time in the market beats timing the market. By intentionally keeping your money on the sidelines for a year, dollar cost averaging acts as a drag on how fast your wealth can compound. If jumping in all at once is mathematically superior, why do so many smart, experienced investors still choose to take the stairs? It is because our brains are wired with a strange imbalance. We feel the pain of losing $100 twice as sharply as we feel the joy of gaining that same amount. Let's apply this to our $12,000. You take the lump sum approach and jump straight in. But the very next week, the market crashes by 30%. The shock is exactly like hitting freezing water. The immediate instinct is to panic, pull your money out, and permanently lock in a massive loss. Now look at the person taking the stairs. When the market crashes, they don't panic. Their next automated $1,000 investment simply buys shares at a 30% discount. A terrifying crash becomes a massive buying opportunity. Dollar cost averaging works because it automates your discipline. It keeps you moving forward when your emotions are telling you to run. So how do you choose? Taking the stairs makes sense if you are a nervous beginner, if you just inherited a large sum of money, or if you want to completely automate your decisions and forget about them. In fact, if you contribute a portion of your monthly paycheck to a retirement account, you are already using a highly effective form of dollar cost averaging without even thinking about it. Jumping in with a lump sum makes sense if you have a high risk tolerance. You need an investing timeline longer than 10 years and the emotional discipline to watch your portfolio drop without panicking. Deciding between the two comes down entirely to knowing oneself. You have to honestly ask if a sudden 30% drop in your account balance would cause you to hit the sell button. If you are still torn, there is a very practical middle ground that most people completely overlook: the hybrid approach. It works like this. You take that $12,000 and invest 50% immediately to capture the long-term growth. Then you spread the remaining 50% out over the next 6 months to cushion any sudden drops. The hybrid method gives you a balance. It respects the math that favors getting your money into the market early, while also respecting the human psychology that fears a sudden crash. Ultimately, pacing yourself or using a hybrid approach prevents the absolute worst outcomes. It keeps you from trying to perfectly time the market, it stops you from panic selling, and it gets your cash off the sidelines. A perfect mathematical model is useless if you abandon it during a crash. Success comes from choosing the strategy you can actually follow for decades, without flinching when the market gets rough. If this helped clarify your investing options, please subscribe. In the next video, we are breaking down the 4% rule, so you can calculate the exact amount you need to safely retire.